quick before I turn it over to my colleague Barka Patel. I just wanted to, number one, note that this presentation is just general information. Barka is really smart and knows a lot about nonprofit law, but she does not know the specific facts about your organization. And we welcome questions. Barka will tell you more about that, but this is just general information. And lastly, I just want to highlight a few upcoming events that we have. September 5th, we are doing legal nuts and bolts of managing employees and volunteers in Cincinnati at Interact for Health. We are co-sponsoring that with Leadership Council. On September 24th, we have our Foundational Basics of Nonprofit Law session, and that will be at the Miami branch of the Dayton Metro Library. And then on October 24th, we have the legal nuts and bolts of board meetings. So I know a lot of people who are dialing in are board members of nonprofits, and the purpose behind that seminar is to really just go through what should be in minutes, how do we take minutes, just very basics, how to run board meetings, and talk about a lot of best practices. So all of that information is on our website under events. So we hope to see you and meet you in person. So without further ado, we have two fantastic speakers for you today. Barka Patel will be speaking first. She's Pro Bono Partnerships Director of Education and Senior Counsel. And after her, we have one of our fantastic partners, Stephanie Allgaier, who is a shareholder with Von Lehman. And she specializes in nonprofits and governmental entities. So both of them have a lot of information. So sit back. I hope you're well caffeinated. If not, you might want to grab a quick coffee before we get going. And Barka, here you go.
Thank you, Erin. Thank you all for sharing your lunchtime with us today. We're really excited to have you. Just before we get started, you'll see a Q&A box on the side of the slides. Feel free to type in a question if you have it on there. We'll try our best to answer them as they come along, or I think we've left a little time at the end of the webinar to do so. So my goal today is to give you a basic overview of nonprofit board members' legal duties under Ohio law. And before I do that, let's actually get to the slide here. We'll also discuss best practices for fulfilling those legal responsibilities to your organization. And then, as Erin mentioned, Stephanie Allgaier from Von Lehman is going to go over some practical tips to reduce the risk of funds being misused in your organization by implementing internal accounting controls. And this is also a really important part of your fiduciary duties as a board member. Just a quick note. So the majority of what we are discussing today is Ohio law that applies to all nonprofits in Ohio. There's going to be a couple of times, especially in the section on compliance, where I mention the Internal Revenue Code or tax-exempt status, and we just want you to be aware that I'm referring specifically to 501c3 public charities when I do so. So now that that's out of the way, let's get started on some important background information. So, as a board member in Ohio, you are a fiduciary of your organization's resources. And what that means is that you're in a position of trust, right? The charity's assets are entrusted to you for the benefit of those that your organization serves. In fact, because the assets of the charity are intended for public benefit, they don't really belong to any one individual. So if the charity dissolves, those assets have to be distributed to another 501c3 organization or to the government, local, state, or federal, to be used for another public purpose. Now, if your organization has tax-exempt status as well, your charity has additional responsibilities. The IRS took a leap into corporate governance or nonprofit governance with its revised 990 in 2008, and I'm sure all of you are aware of that. Before 2008, the tax return for tax-exempt organizations looked like what you would think a tax return should look like. And in 2008, the IRS started asking multiple questions about nonprofit governance. It's made it a priority to review the governance of public charities and especially policies and procedures. So now that we understand the importance of what you do as a board member, let's take a look at what your responsibilities are. So this is a basic overview of what they are in Ohio. We're going to, of course, break these down and talk about what they mean in practical terms and go over some best practices. But just to give you a basic overview, the duty of care. So this involves being active in your organization's activities and understanding its mission. The duty of loyalty. This means that you should always place the interests of the charity above your own interests. The duty to manage accounts. Board members are responsible for the charity's financial stability and its accountability. And the duty of compliance. Board members must ensure that the charity is following registration requirements, solicitation laws, and tax provisions. So this is what we really want to stress here. The duties that you see here are the same regardless of the size of your organization or the size of your board or the size of your budget. So you could be an organization that has 0 paid employees, 3 members on your board, and a $1,000 budget, and these duties look exactly the same as an organization that has 100 paid employees, a 30-member board, and millions of dollars worth of money in their budget. How you carry them out, practically speaking, may look a little different, but you're still held to the same standard, and that's really, really important for you all to understand. These duties are the same regardless of whether you're new to the board. You could be fresh-faced and new to the board, and this is why it's really important when your organization sends you an onboarding packet or organizational documents to review. Make sure you're doing that. Make sure you're reviewing your articles of incorporation and the bylaws, any policies and procedures, financial statements, strategic plan, really anything you can get your hands on to be informed so that when you walk in on day one, you're able to ask important questions and you're able to make informed decisions. Now, sometimes there's a founder that is really active on the board or in the operations of the charity. There could be an executive director that's been in that position for a long period of time. It's important to note that a board can't simply defer to a founder or an executive director. You can't just rubber stamp decisions without asking questions and exercising independent judgment. Sometimes, and I think it's important to note, nonprofit boards are operated under the impression that everyone's just kind of helping out. They're volunteering their time with a feel-good nonprofit, and it's a great change from their daily 9-to-5 job. This can lead to a tendency for a board to act informally. What I really want to stress here is that a nonprofit is still a business. It is still regulated on the state and federal level, and in some ways, even more so than we would think compared to a for-profit business, because of the fact that you accept tax-deductible donations, the fact that you manage public assets, and a couple of other considerations as well. So let's take a look at what some of the consequences are if you don't fulfill your fiduciary responsibilities. So directors can be held individually responsible for breaches of fiduciary standards within a charity. So an example we like to use, if charitable assets are sold at less than fair market value, directors can be held accountable for the difference there between fair market value and the selling price. If a conflict of interest is involved with a transaction, there could be fiscal penalties levied against board members. And criminal fraud charges are possible when board members completely ignore their charitable obligations and they personally profit from the assets of the charity. So breaches of fiduciary duty can also result in the loss of the public's trust for the organization. Now, we all know that safeguarding your charity's reputation is incredibly important. Breaches in fiduciary duty can affect your organization's ability to raise funds, attract volunteers, and really gain other types of support. Now, starting off with a bang here, I certainly don't want to discourage board service. What you do by sharing your time and expertise with charities that play a vital part in our community is really, really important. We just think it's important for you to be aware of the risks and be aware of your responsibilities to protect you as a board member, but also to protect your organization and its assets and just ensure that it's around for a long time to come. Your charity really needs you and it needs your service, but what it really needs is for you to do a good job as a board member. So let's take a look at your fiduciary responsibilities and let's take a look at what it would take for you to do a good job for your charity. So the duty of care. So under Ohio law, a director should perform the duties of a director with the care that an ordinarily prudent person in a like position would use under similar circumstances. So what does this mean? It means be active in the affairs of the organization. A great rule of thumb here is Treat the affairs of the organization the way you would your own, and treat the money of the organization the way that you would treat your own money. If you would maybe get a couple of other quotes before renting office space for a 3-year time, commitment with your own money and in your own business, and that's certainly what you should be doing with the organization's money. So that's a great rule of thumb there. Board meetings that are well planned and well run are really going to go a long way in helping directors meet their duty of care. Best practices is have the agenda emailed out before the meeting along with relevant materials. This is going to help directors prepare for meetings. It's going to help them actively participate when they're in the meeting, and it's going to help them make informed decisions. You also want to ensure that adequate minutes are taken. Minutes should be circulated prior to the next meeting for review and approval. You don't want minutes to recite each and every comment that was made, but they should be recording important items and votes and resolutions. They should reflect that questions were asked and that discussion took place in your meeting. One of the key items that falls under duty of care is the oversight and the review of the executive director. And this can be a challenging area for nonprofits sometimes because the executive director may be the founder or the person who really got the nonprofit up and running. They may likely be the person with the longest tenure in the organization because the board has turnover due to term limits. Regardless, it is the board's fiduciary duty to review the performance of the executive director. And some of the best practices here in this area is do a formal written performance review each and every year. Engage in a goal-setting process with your executive director, do an annual review of compensation, and when you do that, consult external salary surveys, and those are really just data points that show you what executive directors at similarly sized organizations are making, and make sure that the full board is approving the compensation package each year. Just a side note under duty of care, under Ohio law, if you're present at a meeting and a decision was passed and it's not recorded in the minutes that you voted no, it's going to be presumed that you voted for that decision. So always cast your vote at board meetings. If you voted no for an important decision that was passed, when those minutes are circulated prior to the next one, make sure that it's noted in there that you did vote no, and make sure that that's corrected as well. So it's also the board's responsibility to help develop policies and procedures. And there's many that you may want to consider depending on the activities of your actual organization. From an accountability standpoint, 3 policies are highly recommended. All 3 are asked about by the IRS on the 990. The first is a conflict of interest policy, and that, of course, establishes a procedure for disclosure, independent board discussion and vote, and documentation when there's a perceived conflict of interest. So not to bore you too much during your lunch hour, but the Sarbanes-Oxley Act, I have to mention it. It was passed a couple of decades ago in response to some corporate scandal that you may remember. And it was passed really with the intent to restore trust in the corporate sector. And the vast majority does not apply to nonprofits, so you can breathe a sigh of relief, but there are 2 provisions that do, and that's what the next 2 policies that we recommend having in place really are there to address. Sarbanes-Oxley imposed criminal penalties for a corporation, including a nonprofit corporation, for retaliating against a whistleblower. So we recommend having a whistleblower policy in place, even if you have no paid employees. This type of policy just establishes a formal process to deal with complaints and to prevent retaliation. Sarbanes-Oxley also imposed criminal penalties for altering or falsifying or destroying documents in advance of an official proceeding. So for that reason, it's recommended that you have a document retention and destruction policy. This type of policy will outline mandatory document retention and periodic destruction. So let's move on to duty of loyalty. So under Ohio law, a director should perform the duties of a director in good faith, in a manner reasonably believed to be in or not opposed to the best interests of the corporation. So what does this mean? Act in the best interest of the charity, not yourself, your business, your family members, or your friends. And the best practices are things that you should all be pretty fairly familiar with. You know, establishing that conflict of interest policy, including written disclosures that we discussed earlier, scrutinizing business relationships with the board member and the charity. You just want to make sure that these relationships truly are in the best interest of the charity. As a board member, you shouldn't engage in transactions that hurt the charity or that compete with its interests. Of course, don't divert the charity's opportunities for personal benefit, and keep confidential information confidential. What we're really talking about here, of course, is conflicts. And it's important to note that even in a well-run organization, one with a conflict of interest policy, board training, procedures for written disclosures, there are multiple opportunities for conflicts to exist. And it's important for the board to be aware of this because they themselves have to be vigilant. They have to be able to recognize the potential conflicts when they come up, and they have to be open to discussion in order to address and resolve them. So each board member, each of you, is accountable for identifying and disclosing your own conflicts. Fellow board members are responsible for raising the issue if they see something with another board member. And again, this is a really tricky area because it's not always apparent right away that a conflict exists. There are ethical gray areas that could really lead different people and different boards to different conclusions as to whether something is a conflict. And for those gray areas, we really think it's important for your board to feel comfortable engaging in discussion. You know, ask yourselves, how would the media or our community or the public react if they knew about this action or this relationship? And I think this is an important way to think about it because even a perceived conflict could result in damage to your reputation as an organization. So again, this type of discussion, if it's part of your organizational culture, is really going to help your board effectively handle potential conflicts as they arise. So I think this is a good time to mention, kind of as a side note because it's an overlapping issue, the Internal Revenue Code's prohibition against private inurement. So in plain terms, insiders of a tax-exempt organization, so of course that includes board members, can't benefit from their relationship with the organization. They can't benefit more from that relationship than the benefit that they're providing to the charity. If they do, the organization can lose its tax-exempt status and the board member could be fined. So how do you handle a board member's relationship with the organization? How do you make sure that that relationship's reasonable? Disinterested board members have to approve the relationship in advance. You want to use objective comparability data, and you want to document the decision in the minutes. So to give you an example, let's say that a board member has an office space to rent to the charity. The other board members would want to approve that relationship in advance. They're going to want to get other quotes for rent in the area and just make sure that what they're going to be paying this board member is reasonable. And they want to document that whole decision-making process and the fact that they consulted other data points there in the minutes. So let's move on to the duty of compliance. Board members have a duty to be faithful to the purpose of the organization and its mission and adhere to the governing documents and to laws and regulations. So there's a lot to unpack here. I feel like I could talk about this for about an hour of everything that's actually encompassed in the duty of compliance, but we'll try to do a good job of giving you a basic overview. Some of the best practices: review your charity's articles of incorporation. So most likely these were drafted decades ago unless you're a brand new organization. They will say that your charity's activities will be limited to the stated tax-exempt purpose. So take a look at that purpose. Just make sure it's still matching up to what you're doing today. Sometimes charities evolve over time. So it's good to review that. Your bylaws. You should be incredibly familiar with your bylaws. They are the operating manual for the board. Some people suggest that they should, be sitting there at every single meeting. They should be very clear. They should be able to answer your questions. If you have questions about whether your board has quorum, how the meetings are to be conducted, or any procedures, you should be able to consult your bylaws and get a pretty clear answer. The things to look out for with your bylaws is you want to make sure that your practices are actually matching up to the bylaws. So, for example, if your bylaws say that your annual meeting has to take place in the first quarter of every year and you as a board are consistently not doing that, something needs to change. Either your organization needs to change its procedures, or you need to amend your bylaws, but you just want to make sure that they're consistent. So your organization originally would have filed your articles of incorporation as a nonprofit with the Secretary of State. So you're required to file what's called a Statement of Continued Existence with the Secretary of State of Ohio every 5 years. A separate and distinct requirement is an annual filing with the Ohio Attorney General, and that is for charitable solicitation, asking people for money. So that is something that you'll do every single year with the Ohio Attorney General. And when you're talking about charitable solicitation, it's important for you to know as a board that that is a topic that is unfortunately regulated on the state level. So approximately 40 different states have registration and reporting requirements for charitable solicitation. The rules, the requirements, the threshold amounts, and even sometimes the definition of what a solicitation is varies from state to state. So as a board, it's instead of getting into the weeds here, just know that even if you're a small local nonprofit in Ohio and you are, of course, hopefully registering with the Ohio Attorney General for solicitation every year, don't assume that you don't need to register in other states. Take a look at where you're actually soliciting. Take a look at where you're sending emails, where you're making phone calls, among other things, and take a look at where you're getting your donations from. You might be very surprised to know that you have to register in another state for soliciting funds. Another reason why that's so important, just as a side note, is that there are fines, and some states impose criminal penalties for soliciting their citizens without registering in advance. Donation acknowledgments. Know that you are required to send donation acknowledgments. The timing of when you send them, what should and should not be included, is regulated by the Internal Revenue Service, so know that those requirements exist. As we said before, your 990, which is your information tax return to the IRS, has to be filed every year. Best practices for your board to actually look at that and review it before your organization submits it. It's a public document. It says a lot about your organization. It has your name on it as a board member, and we think it's really important for you to be able to fully review that before it goes out there in the public. As a board, it's important for you to understand the limitations that are imposed on you by the Internal Revenue Code on your tax-exempt public charity. Just briefly, one of those is lobbying. So this is a very misunderstood area of the law. Your organization, if you're a 501c3 public charity, can lobby. It's just that the amount that you lobby is limited. So sometimes organizations don't realize that there is a limit here, and sometimes organizations are so worried about the limit that they won't lobby at all. And really neither of those is ideal. We want you to know that you can, but of course there are limitations. With lobbying, even if you're not really paying anyone to lobby, it's really important to track the time that your staff is spending on it, the time that your board or your unpaid volunteers are spending, basic overhead, because even if it's a tiny amount, you have to report those things on your 990. So another limitation imposed by the Internal Revenue Code is that a tax-exempt public charity cannot support or oppose a political candidate running for public office. So that's at any level, federal, state, or local. And any amount of political activity can really result in the loss of tax-exempt status for your organization. What I want to point out here is that as a board member, of course, you can be involved in political activities as an individual. But your organization can't directly or indirectly authorize that activity. So as a board member, you just want to be careful that you're not making partisan comments in official organization publications or at organizational functions. You don't want to use the organization's facilities, employees, resources, copier machine. You don't want to use anything of the organization's to do your own individual political activities or political campaign activities. Just a final note on duty of compliance. Tax exempt means that the charity is exempt from income tax on related business income only. So you may still have liability at the state and or federal level for unrelated business income, and that's income generated from activities that are not related to your mission, sales tax, property tax, employment taxes. So don't just assume that you're kind of free and clear and you're exempt from all taxes. So the duty to manage accounts. Board members are responsible for the charity's financial stability and accountability, and they do this primarily by establishing policies and procedures to help the organization operate in a fiscally responsible manner. Best practices include developing and monitoring the charity's budget. You want to be well versed in the financial statements. If you are uncomfortable with the financial statements, find some training and become comfortable, because this is a very important part of your fiduciary responsibility. Have a basic understanding of what operating reserves are and what restricted funds are, if that's applicable to your organization. Of course, as board members, you're responsible for investment of your organization's assets. The 990, again, as we mentioned, is public. Read it, understand it, and understand what it's actually saying about your organization. It truly does tell a story. You want to develop fundraising goals, and yes, it is part of your fiduciary duty to help fundraise for the organization. And of course, you want to maintain records of income and expenses, activities, different transactions. I know Stephanie Allgaier from Von Lehman is going to dive into this a lot deeper than I did as far as the duty to manage accounts, but implementing internal accounting controls is so important, those checks and balances. Even if your organization has 0 paid employees or just a handful of employees, there are ways that you can do that, and it's, you don't think that theft can happen in your organization, but it can. And I know Stephanie is going to have some wonderful guidance for you on that. And before I hand it over to her, I just wanted to go over some great resources for board members. Of course, our website, PBPO. We have multiple seminars and webinars and legal articles that we do every year. We're going to send you a survey after today, and we'd love it if you could write down topics that you would like to hear more about. I know we glossed over a lot today because it's a lot to cover in the 30 minutes that I had, but if you'd like to see a deep dive into anything at all, please let us know. We definitely take those comments into consideration. The Ohio Attorney General's Office. So the fiduciary responsibilities that you saw up on your slides today is directly from a guide for charity board members from the Ohio Attorney General. It is a fantastic resource. You can find it on their website. You can literally print it out and hand it out at your next board meeting to every board member. It'll really go a long way in giving them a good overview of their fiduciary duties. And then the IRS Stay Exempt website for 501c3 organizations. It really does a great job of doing a deep dive into the topics of like lobbying or political activities or some of the other things that I talked about in relation to having tax exempt status. It just does a fabulous job of that. So that's a great resource for you as well. So let me turn it over to Stephanie Allgaier from Von Lehman, and thank you all so much for joining us today.
Thank you, Barca, and thank you for everybody being on the line today. As mentioned, my name is Stephanie Allgaier. I'm the shareholder with Von Lehman and Company that runs our nonprofit and governmental niche group. And on top of that, I'm also a certified fraud examiner. So I specialize with that designation in the prevention of white-collar crime, which is specifically somewhat what we're going to talk about today. And this is kind of a timeline of what we're going to go through, and I'm super excited to follow what Barco went over, because a lot of this ties into the fiduciary responsibilities of not only a board member, but also of an organization as well. And the main takeaway today is to remember that as a board member, your fiduciary responsibility for the financial aspect of things is to make sure that these things are not only being done at the board level, but you're responsible for making sure and overseeing that they're being done by your executive director and any other sort of management that you may have at your organization. So, before we talk about internal controls, let's go ahead and define it. Normally I don't read, but it's very good to understand kind of the main topic of what we're going to talk about. So, internal control is a process. It's affected by an entity's board of directors, management, and other personnel. So it's all encompassing of everybody that might touch the organization. And it's designed to provide reasonable assurance regarding the achievement of objectives. So reliability of financial reporting, effectiveness and efficiency of operations, and compliance with applicable laws and regulations. And a lot of the times I hear, well, we're a small organization, kind of like Barca mentioned earlier, but what is the concern? So studies have shown that occupational fraud costs an organization an average of 5% of revenue loss each year. So when you're looking at, growing our budget, we want to grow by 10% this year for our gross revenues. Well, does that really mean 15% if 5% is somehow walking out the door? It could possibly. And everything centered around internal controls is kind of broken down by the fraud triangle. And this is kind of the premise for everything. Donald Cressy was actually the creator of the fraud triangle, and he created it many, many years ago, well before I was even born, and it still stands today as the basis for everything. But the purpose is that all three factors must be present at the same time for an ordinary person to commit fraud. Obviously, there may be some non-ordinary people, and these people are just kind of... I'm sorry, real quick, just to break in, it seems that we're having some trouble with the audio. Can someone let us know if they can hear it? Oh, okay. Perfect. Oh, thank you, everybody. Very helpful. Very helpful group. So with the fraud triangle, so like I said, all three factors have to be present. And the main thing that we're going to talk about today is opportunity, because where you have financial pressure, and these might be things in a person's life where maybe they have a family member that's going through a health crisis or some sort, or they may have a gambling addiction and need to meet certain debts, or maybe they're living outside their means, but that's what's generally considered financial pressure, and there's nothing that you can do as an organization regarding those. Rationalization is somebody might have the thought process of, well, I'm not paid enough, or I don't have the necessary tools that I need at my job to efficiently and effectively complete my work on a daily basis. So there's not a lot you can do about rationalization, but the biggest thing is to just not be the cause of it. If you're aware that everybody has the worst computer ever and they're 15 years old and nothing works, and I understand sometimes that there's difficult situations with budgets, but if people can't effectively do their work, they may be able to rationalize committing some sort of fraud. But the biggest thing that we want to talk about today is the opportunity, and it is truly the only aspect that you have control over. So opportunity is somebody's solution. The first things they come up with are the first two. And, they might have financial pressure and they might have rationalization, but if they have the perception that opportunity is there, it's the last piece of the puzzle that they need in order to commit a fraud. And as I mentioned, it only has to be the perception. So that doesn't necessarily mean that the opportunity is there, but maybe just the perception. And what can you do as an organization? Remove the opportunity and the perception of it. That's the whole basis of internal controls. So just a couple things regarding internal controls, and obviously not a lot of these are going to be done at the board level, but it may be your responsibility to make sure the executive director or the management of the organization have set up these policies and procedures and that they're monitoring them. So just a few highlights and some examples, but an individual that writes checks should not be signing checks. So it's, you hear a lot about segregation of duties and that type of thing. And the premise is that not one person should be handling one function of the accounting process. So there's nothing that says that the one person has to handle receipts coming in, processing receipts, going to the, we can separate those things And so part of your accounts payable people might be able to do a function of accounts receivable. An individual submitting payroll should not be in charge of setting up new employees or making changes. So if I'm 100% in charge of the payroll function and nobody's really oversighting what I'm doing, what keeps me from setting up members of my family or my friends or even people that don't exist and running them through the payroll system if there's no oversight? An individual should not be in charge of receiving receiving and depositing receipts and recording into the accounting software. So maybe we receive some checks, and again, checks are very, very easy to manipulate, even this day and age, but what would keep me from receiving that check and writing that in as maybe writing off the bad debt and just pocketing that revenue, and nobody's any the wiser? An individual responsible for receiving contributions should not be responsible for thank you letters. One of the biggest catch-alls is when a donor gives us a substantial amount of money, and they're most likely going to be on the look for a thank you letter because they want that for tax purposes or just for their own personal records. Well, if they don't receive one of those, they're probably going to call. Most people would, because they need that to substantiate with the IRS. So that's kind of an added benefit in terms of contributions, but if I'm the person that's receiving contributions, what keeps me from pocketing those contributions and writing that thank you letter and just establishing with that person that I received it, but it never made it into our books? An individual that performs the majority of recording transactions should not reconcile the bank accounts. You can really use the reconciliation process for bank accounts as an added benefit to kind of overlook what all's hitting our cash accounts, what are our outstanding items, and just making sure that, it's just a kind of a second look on things. But if I'm recording everything and reconciling the bank account, the only purpose of that is to make sure the bank account reconciles. And a lot of the things that we hear is, well, Stephanie, we're such a small organization. And Barca talked about it earlier, where the fiduciary's responsibility of a board and really of an organization, it doesn't matter whether your budget is $1,000 or your budget is $5 million. And, a lot of the organizations that we work with in terms of internal controls and kind of looking for their vulnerable areas, they're very small organizations, and they might just have 3 people. And their constant, thing is, I can't segregate duties. There's only 3 of us. So here's an example of just the cash function of how things could be separated for processes for a 3-person office. You have a bookkeeper, an office manager, an executive director, and you may think, well, we don't even have that. But there's, these are just kind of some examples of some employees that you might have, but I can tell you most of the time that we find that the receptionist is the most underutilized person at an organization. This is typically somebody that doesn't have any access to the accounting records, doesn't have any banking access. What keeps us from using this person to possibly open all the incoming mail, stamp everything for deposit only with the name of our organization? That's an added control from somebody that doesn't touch any other part of our accounting system. And then sometimes we even go a little smaller. Maybe there's only 2 people. And quite honestly, you might have just a board of directors and an executive director. And at that point, you really need to take a step back and look at your board and say, what type of board are we? Are we a governing board? Or are we also a governing board and a working board? Does the treasurer of our board maybe need to sign checks? Do we need to be doing a much further deep dive into the accounting records than we would just looking at the budget to actual and those types of things? But here's an example of how you can have cash controls for just 2 people. And it's really a checks and balances between those 2 people. And again, there's always the possibility of collusion, and collusion is one of the hardest frauds to uncover. But hopefully you've got 2 trustworthy people, and I'm not asking you to put all of your trust in everybody, because trust is one of our worst enemies. But here it is how you can do it for 2 people. One of the biggest things for the board, and specifically centered around internal controls, is monitoring. Oversight and monitoring is a fantastic control, and it's kind of that last bit of the puzzle that you can put on there. And again, if you've got very, very limited employees, the board might be doing more of this monitoring than just a large governing board. So review of bank reconciliations with the supporting documentation. You know, just kind of looking at a bank statement doesn't really tell you very much. But if you're looking at outstanding checks and deposits and saying, why did this deposit not go to the bank for, you know, a significant period of time, might be a red flag. Review payroll reports for fictitious employees and reasonable pay. This is one of the easiest and quickest and best things that you can do for the payroll function if you have limited employees is, you know, as a board member, possibly if you're engaged and you're aware of the employees that you have, and you know, you probably also as a small organization approve their pay rate, but just take a look, you know, maybe quarterly or on a yearly basis at a minimum, and make sure that all those employees are people that you know or names that you've heard. And make sure that pay looks reasonable. You know, we've had a lot of cases in Northern Kentucky and Cincinnati specifically centered around payroll records, and people that were having their aunts and their uncles and other names that weren't associated with the organization on the payroll. Don't just sign checks, review the invoices along with the checks. All too often you see an executive director being handed a stack of checks, and you know, you're putting your name to that, or maybe even a board member if there's a second signature, or maybe you're the first signature, but make sure that when you sign checks, you're actually looking at the invoices that substantiate those checks. At the moment you put your name on that as the signer, you're responsible for that money going out the door, and it should be a reasonable and normal expense for the organization. We all do budgets. You know, hopefully everybody does budgets, but when you're doing that, make sure to utilize the budget as a tool. You know, too often you see budgets kind of going directly into a drawer, and it's, you know, it's the process that we had to do, and so we put it in a drawer and we never look at it again. But, you know, utilize those budgets as a tool, and if you can take your budget and break that up into monthly buckets, it'll be a lot easier to assess on a monthly basis where you might be. Request supporting documentation when reviewing the financial statements. So sometimes it's just kind of hard to look at financial statements unless you know what the underlying records are. So think about the packet that you yourself receive as a board member. Is it enough for you to look at and really understand what's going on? So if you're a treasurer and the board members and your finance people or your executive director are coming to you with financial statements, are you looking at just a point in time, a balance sheet at a point in time, or a profit and loss for 1 month? How much information can that really provide you to adequately make decisions as an executive committee or as a board? You know, a packet should be available on a monthly basis to the board to assess, and it should be in comparison to maybe the year before or the month before, and it's more specifically definitely the budget that you have. Review and signing off on write-off reports or change reports. So often we will ask members of the board, if it's a smaller organization, more specifically probably the treasurer, to look at bad debt write-offs. If you have significant amounts of pledges, like let's say you just went through a capital campaign, you have a significant amount of pledges, on a monthly basis, as a board treasurer, I certainly would be reviewing those pledges, receivables, and those write-offs to make sure that nobody pocketed money and to make sure that it's a reasonable write-off. And a little bit further with that is maybe that pledge came from a connection with a board member, and that board member wasn't provided the opportunity to talk to that pledger. Look at voided checks. Make sure that it's not something that wasn't missed. Or credit memos if you are an organization that may sell things, has inventory or things like that. Look at credit memos for things that are being credited back to organizations. But these are some things that the board can specifically look at because the people that are doing these types of things may be upper management, and the last line of defense is the board. Some added controls and culture that will help. Not all of these are financial, but they help with the rationalization side of things. So mandate vacations, including the executive director. It's so often that we hear from an executive director that I don't have time to take vacations, or who's going to handle things if I'm gone? Make sure that your executive director has that time and feels that they're in a position that they can take some time off. Everybody needs some rest and relaxation. Timely and effective employee evaluations. I know Barca touched on this a little bit, but most employees, even if it's criticism, they like to have those evaluations, and make sure, especially with your executive director, that the board is helping your executive director set goals so that they have something to work towards, and so that you can give them feedback when it comes time to either give possibly a bonus, and most importantly, if it's time to give a raise. Cross-training throughout your organization. This will certainly help if it's time for the executive director to take some time off. And also to make sure that, maybe your executive director finds another place that they would like to be employed, that you have somebody maybe in your organization that can run that. Because what happens most of the time is that a member of the board will feel responsible to have to come in and be the interim executive director, and that sometimes puts some pressure on. Show an interest in your employees and their families. And this kind of goes along with, not just the rationalization, but do you know if they have any financial pressures? How well is you as a board know what's going on in the life of your executive director? Do you know if they possibly have any financial pressures or at home? Do you spend time with them? Very much so. You should probably meet at a minimum, just, kind of one-on-one with your, or just as in the executive committee with your executive director, just to see how they feel about things, or if they need any help within the organization and how they feel. Random spot checks on various documents or processes. As a board, you are allowed to ask for any financial information, unless it is HIPAA related, to see, or just to oversight. And this can sometimes go a long way. If your executive director and your finance people know that you have a vested interest in the organization and it's ongoing, and you want to make sure that you're holding yourself fiduciarily responsible, it can go a long way. Barca touched on a little bit, but whistleblower policies and a comfortable outlet for employees. Very often we'll see it where maybe we had an executive director that was a little aggressive, and once that individual retired or left the organization, a lot of people start coming out of the woodwork. But make sure each of the employees, top down, have a comfortable outlet. Now, if you're not sure where you lay with maybe some vulnerable areas that you have, or if what the board is looking at on a monthly basis, have the accountants for the organization talk to you about what you're looking for, and maybe review the controls and processes some. Some helpful tips on detecting irregularities, and these are some of the things that definitely the board should be doing, and more specifically the executive committee or the treasurer, but obviously adopt a yearly budget and use it as a monitoring tool, not just throw it in a drawer. Perform some financial ratios to determine irregularities. What makes sense to your organization, again, might not make sense to another. But if you are looking at, let's say, fundraising as your fundraising expense as a comparison to your fundraising income, and you're aware of what type of fundraising you did during the year, and those ratios aren't from year to year aren't looking like they should, it might need a little bit more inquiry. Review reconciliations for stale or old items. Periodically review your vendor listings for unknown vendors or vendors with the similar names. So sometimes, we ask the board treasurer as an added step, if during an audit, even when we're performing audits, to review the vendor listings. If we've got a small organization with not a lot of checks and balances, we'll have the treasurer take a look at the vendor listing to make sure that those are approved vendors for the organization, that all of them make sense. Sometimes we'll find, well, I have no idea why we pay that person. That doesn't make any sense, and it's really uncovered some kind of scary things. Review for journal entries to accounts receivable or accounts payable. Very often, those should not be in there. And as I mentioned, at a minimum, the treasurer or the executive committee should review payroll journals and W-2s to make sure that there are no fictitious employees and that everybody's receiving proper pay. And I know Barca talked about this as well, but one of the biggest things about fiduciary responsibility for the board is to be aware and be up to date on what is going on with the organization, because if you're not sure what's going on with the organization or the purpose that it serves or its mission or how it goes about doing that mission, it's going to be very difficult for you to look at a set of financial statements and even know if that's a viable set or what's going on. Some recognition and triggers to watch for people, and this kind of goes along with the financial pressure, but individuals that may be living beyond their means And as a board, you're probably most knowledgeable about the executive director, and you're the only oversight of the executive director. So is the ED living beyond their means? Increased stress, recent divorce or family issues, and various different amounts of changes in behavior. Not saying that all of these will absolutely lead to some sort of fraud in any manner, but they're just things to notice for one piece of that three-level triangle. And the biggest thing that I want to have takeaways for in terms of board responsibility is that the board is the governing body of an organization. And therefore, you're tasked with setting the tone from the top and taking on fiduciary responsibilities. Just a few reminders, is the executive director reports to the board. The board does not report to the executive director. And as mentioned, this can kind of get a little squirmish sometimes with maybe you have an executive director that's a founder of the organization, and the board doesn't want to step on their toes. But the biggest thing to remember in the back of your head is that you have the ultimate responsibility for the fiduciary ongoings of that organization, and you are the governance. The board is responsible for governing, and the ED is responsible for managing. That's the only thing you need to remember in terms of that. Management develops and sets a structure of internal control, but the board is responsible for monitoring that structure. So when you go back and you ask your executive director, what do we do in terms of fail-safes and keeping our money where it should be and making sure that our processes are where they should be, and they don't know, you need to make sure that they're developing some sort of structure. And smaller organizations may require a working board in excess of a governing board, and this is always one of the questions that you should ask prior to going on to the board. What type of board are we, and what will be the commitment? Hopefully, before you've decided to go onto a board, you have some sort of passion for their mission. And if you don't have that driving passion, then sometimes you might not be wanting to go on as a working board rather than a governing board. Sorry, I think our slides just disappeared possibly. Oh, there we go. Okay. So I know we've talked about a lot of things, and I know that sometimes we hear from various people that, it couldn't happen to us. We have a very trustworthy individual. We're not a very big organization. I do want to share with you one story, and as a follow-up, this has actually been turned into a documentary and a movie. So obviously then it's really good if it's turned into a movie. So I'm going to tell you about the city of Dixon, Illinois real quick. The population's only 16,000, which is the size of Burlington, Kentucky, where I'm actually from, and that's not even an actual city. There is no city government. We're governed by the county, but the annual budget was approximately $6 million to $8 million, and or maybe kind of so that they thought. But so they had a woman by the name of Rita Crunwell, who was the comptroller and treasurer. But Rita had what we consider to be one of the just an epic amount of opportunity. She recorded, reconciled, and performed every function at the city. The only thing that the city council recommended that she bring to the council was kind of a presentation of summarized financial statements, and she always had explanations for deficits. But Rita had worked there for over 20 years and just had gained an incredible amount of trust from everybody involved. Rita also had a very lavish lifestyle. She had a lot of financial pressure. She had many hundreds of horses that she bred, and she was very, very well known in the horse community throughout the United States. She had a lot of rationalization as well. She needed to uphold those appearances, and she was trying to do that on only an $80,000 a year salary, which she may have felt that she deserved more with being there for so many years and how much information that she processed through the organization. But the biggest thing, more than anything, is she had an incredible amount of opportunity. She was able to go to the bank and set up a fictitious bank account, and she was able to falsify invoices. She was able to cut the checks for those invoices and transfer money. And over a period of 20 years, Rita Crunwell was able to walk away with $54 million. And it was all because the amount of trust that the city council had placed on her and the opportunity that she had. It was only actually caught because another member that was in the office of the city came in to look for something, and the mail happened to come in. and she happened to see the bank statement that made 0 sense as to why, because she had never heard of that. But it just goes to show that the amount of trust that you can have from people, and trust is good, you should have reliable employees, but without breaking down that third piece of the opportunity, anybody that has all three sides of that triangle can make it happen. The last thing I want to kind of leave you with is the report to the nations, and this is put out, just a quick executive summary, but this is put out by the Association of Certified Fraud Examiners. But less than 10% of fraud is financial statement fraud, but it yields the highest median of loss. So it's easier for me to manipulate financial statements, which you're supposed to look at on a monthly basis, than it is for me to physically steal money. 94.5% of cases use some form of concealment, and most common is creating and altering physical documents. I don't know how to do it, but you look at some of the capabilities that are just not only in some of these fancy programs that people have, but just in some of the more expensive Adobe programs that we have. It's amazing what you can do with documents. The median loss is much lower when active detection methods are in place. Obviously that makes sense, and it's kind of common sense as to if there's only the perception but not the actual opportunity, most likely if it's just perception, it's going to be caught. The median loss by small organizations, that's less than 100 employees, was the same as large organizations. So that's a little hard to swallow for some of us that sit on some boards of smaller organizations, that the median loss is typically around the same as large organizations. And that is because for small organizations, not enough emphasis is put on the fiduciary responsibility of internal controls. Corruption is more prevalent in large organizations, and schemes such as check tampering, skimming, payroll, altering documents is more prevalent in smaller organizations. 29% of cases was a lack of controls, and 20% were more from management override or board override. So think about that. With proper controls in place, 29% of fraud probably wouldn't have happened. 82% of fraud cases were undergoing their independent audit. And the biggest thing to remember is your audit is not designed to detect fraud. At the base of my career, I am an auditor, and if you read your audit opinion, if you look at your engagement letters, you look at your management representation letters, it's a reasonable assurance. We don't look at everything. But so your audit is not designed to detect fraud, and if you're sitting back and thinking that at the end of the day, everything should be fine because we get an audit, 82% of fraud cases were undergoing independent audits. And I think that's all that I have. If we have any questions from people, we'll be happy, either I or Barca will be happy to take those.
Great. Well, hopefully we've been able to answer all the questions that came in during today's session. If you have any questions that come to you after today, please feel free to reach out to us. We want to be a resource to you. Again, our website is www.pbpohio.org, and all of our contact information is on there. Thank you all for your time today.